All right, welcome back to video number 3. We're going to be talking about finance. Like the last video ended off by saying, finance is probably the worst topic for most students. Now, I can tell you from past experience, I would agree with you. I hated finance as well. I'm also really bad at maths. If you've never been to one of my lectures, you won't know. But if you have been to one of my lectures, you will know how bad I am at maths. That's why I chose to study law and commerce and not like finance or something like that. Now, in terms of finance, we really need to make this as simple and easy as possible. How I can do this for you is let's just break it down to the basics, get the basics down first. Once you've got that done, then we can go in and do more developed strategies and ideas, all right? Now, what I'll do is I'll relate this to as much real life as possible so that it kind of becomes a bit more relatable, because that's what my struggle in finance was. It is that, it kind of never made any sense for anyone because no one's really seen this in real life before. So let's give you some examples to help you. All right, now let's hit it. Finance. Finance is about the analysis, interpretation, and evaluation of your financial records. Again, strategic role is about the long run. Especially for finance, this is the most important. You need to make sure that your financial stability in the long run is maintained for your business. Otherwise, your business is going to suffer from low cash flow, not enough money in the bank, not being able to invest, not being able to pay staff, not being able to pay suppliers. The list goes on. So strategic role, long term, must focus on it. But again, with all of our objectives, we must remember that we can't achieve all at the same time. We need to balance our objectives according to what we profit or what we value the most. So we must weigh up what our goals are and fit those that match. All right, now in terms of the role of finance, the easiest way to remember the 5 objectives is by using the phrase PLEGS. That is profitability, liquidity, efficiency, growth, and solvency. If you can remember these 5 for the whole finance topics, you've got practically everything. This helps you with formulas. This helps you with strategies. It literally does everything for you. So very, very important. All right, now in terms of profitability, that is how much money is left over after all expenses are paid. In terms of liquidity, that is, are you able to pay your short-term debts? Now, a lot of people used to get confused between liquidity and solvency. So we'll go through those 2 quickly now. So again, liquidity, short-term debts. Solvency is your ability to pay short and long-term debts. So the way I used to remember it is think about a glass of water like this. Liquid is really, flexible. It's all about the ability to pay in that short term. In solvency is more about the long and short term. So I use solvent in the long and short run. Now, the best way I remembered it, as crazy as it sounds, was because when I was studying about what the difference between liquidity and solvency is I had a cup of water sitting next to my laptop as we speak, and I spilt it on my laptop, and there goes $2,000. So I'll never forget, liquidity is that short term, how liquid your funds are in the short run. The way I remember it is in the middle of the exam, just do one of these ones, liquid, water, flexible, short-term flexibility. That's the easiest way to remember it. Next is efficiency. Efficiency is all about your expenses. How much revenue is left over after all of your expenses have been paid off. And lastly is growth. That is the size of your company compared to competitors. Now, some key terms here to go through just to keep you in mind of what's going on. A lot of kids get stuffed up with these words, so let's help you fix that stuff up. Dividends. Dividends is when you go and buy a share and the company makes profit, your return is, in return, you get dividends, which is the company paying you a portion of those profits because you invested in shares. Gross and net profit are 2 totally different things. Kids need to realize this. Gross profit is revenue minus cost of goods sold, and net profit is that gross profit minus expenses. So if you have a look at this diagram over here, the easiest way to remember it, gross is revenue minus COGS like normal. Yes, it does give you profit, but it's not the best estimation. Net profit is the best estimation of profit. because it gets rid of all your other expenses. So think about this. When you've got a fishing net in water, for example, you scoop out that gross profit and all you're left with is the net. Inside the net is your net profit. And you've kind of scooped out all of those expenses that you are charged. So net profit is really the best one to go with there. An invoice is just like a receipt or a docket that businesses use to show financial transactions. Now, debtors and creditors and accounts receivable and accounts payable are very much linked. Accounts receivable is money you expect to receive. That is money that comes in. Accounts payable is money you have to pay out. That is to your suppliers. Now, if you have money coming in, they're your debtors. If your money going out, that's your creditors. So you're expecting to pay them. Now, you have to really kind of get an understanding or an idea of what these words mean, because the pluses and minuses make a real big difference. Why we use accounts receivable and accounts payable is because in real life, let's say I went and bought, a pallet of nails for my parents' company. Even though I received those nails today, I don't have to pay for those nails for another 30 days, 40 days, 60 days, depending on our contract between our agreement. So whilst I received the nails today, I, in my accounts payable, have to pay them, the nail company, the money in about 30 days. Then for the nail company, they have an accounts receivable for that exact same amount. Next is financial influences. Now, finance can be sourced from internally and externally. Internally is using your own capital, using your own retained profit from last year, or selling unwanted machines, cars, assets that you don't need anymore. They're all internal sources of finance because they come from within the business. External finance, though, is separated into two categories: debt and equity. Debt is when you get loans, borrowing money from a financial institution, you pay interest. Equity is more about shares and ownership. Now, we're going to go through both of those first. Let's go through debt first. So debt can be broken up in short or long-term influences. That is, short-term is less than 12 months, long-term is greater than 12 months. So the first one is an overdraft. That is, when your bank balance goes below zero, the bank borrows you money. Overdrafts, though, are very, very expensive. Yes, they're convenient, but they're super, super, super expensive because banks know you're in a lot of trouble in order to do it, so they know they can charge you a higher interest rate. So, biggest advice, if you see in a business report or an essay or strategy or whatever like that, you need to make sure that the company is not abusing its overdraft, because if it's using an overdraft at all / too much, then the company is not being financially responsible. There are so many other strategies a business can use to be more financially responsible. Next is a commercial bill. A commercial bill is a written loan amount borrowed from another person or another account who has extra funds. And again, you have to repay it at a certain date at a certain rate. And it can be rolled over to the next month or to the next, 3 months. And it's a much more cheaper way to do it than, say, overdraft. Factoring, on the other hand, is when you sell your accounts receivable. So remember the nail story we were just talking about before? Let's say that I am the nail company and I'm in a bit of financial pressure. I can't wait those 30 days. What I do is I sell it to a factoring company. I sell my accounts receivable at a discounted rate. They'll pay me instantly, but it is a less amount. So let's say, for example, I sell $1,000 of nails and I'm waiting for $1,000 to come into my bank account. Now, if I go and sell it to a factoring company because I can't wait those 30 days, whilst yes, it's good, it does mean that I sell it to them for $600, not the full $1,000. So I don't get the full value of the money, but I do get it much faster. So you've got to weigh up what you need more. Obviously, they charge a commission or fee depending on the risk, depending on the amount, depending on who the supplier is. So that's the short-term strategies. Now, the long-term strategies is things like a mortgage, which is where you get to borrow money from the bank, paying back both the full amount plus interest. You need to usually have an asset on security. So a security is when, let's say I can't pay the loan anymore, they come and take my house. That's what a mortgage is. Debentures. Debentures are when one business lends another business money for a fixed time, rate, and amount. They can either be issued publicly on the stock exchange with a prospectus or just done privately between two businesses to get money really quickly. So that's what a debenture is. An unsecured note. Now remember, in an unsecured note that is notes that are issued by a finance company, but because it is unsecured, it means that if I go bankrupt, that financial company can't really get their money back. Now, because that's a lot more riskier, they charge a higher rate of interest. Very, very risky. So you have to be very careful. Next is a lease. That is when you, rather than owning an item, you just rent the item on an agreement. So for example, instead of owning a car, you lease the car and you pay certain amounts. The benefit is that you're able to realize, there's a fixed amount at a fixed time. You're able to really budget that a lot easier. It's also tax deductible. The negative of it though is that, at the end of the day, you don't own the product. So you can't count it as an asset. You can, however, decide to release the item, update and get a newer model, or buy the item after the lease is finished for a discounted value at whatever its leftover cost is. So in terms of these debt strategies, you really need to pick a strategy or a financial option here that suits the company. And we'll go through that in a second. Now, in terms of equity, you can either have private or public. Private is all about selling shares to private investors. That is, you pick the investor yourself. You don't have to pay back dividends until profit is made, but you pick private investors yourself. Public is the ones that are sold through shares. So it can either be a new issue where it's the first time being issued on the stock exchange. It could be a rights issue. It could be a placement or a share purchase plan. Now, in terms of the rights issue, it's more about where an existing shareholder who's already invested in your company is offered more shares proportional to the amount they own. So if a person owns 10% of shares and I'm about to go and release another 100 shares, I'll offer them another 10% of the next slot of shares if they want to. Placement is literally in the name. It's when you place certain shares into a certain shareholder that you specifically want to have. It's a lot faster, can happen in less than 24 hours, and you can raise a lot of money. You don't need a prospectus either. Now, a prospectus, a lot of kids ask what this is. A prospectus is when you issue shares on the Australian Stock Exchange, you usually have to issue a prospectus, which is almost like a document, a brochure telling you what company, how much you're investing, how much stock you're raising, what you're going to be doing with the money, what your expected anticipated results and returns and dividends is going to be. It's almost like a sales brochure for your shares. That's what a prospectus is. Now, number 4 is a share purchase plan. That is when you offer existing firms up to $5,000 in new shares, according to who already owns shares. You offer them at below current price rates, so that way you can get funding really quickly. It does need the approval from ASIC, but it is quick and inexpensive. The problem is it really does undervalue your company's shares a lot, because if you're selling shares less than the market value, it means each share is now worth less because you're not only putting more shares, but they're worth less. Other financial influences are financial institutions themselves, that is banks, investment banks, super funds, unit trusts, all those kind of things. Government, however, government also do influence you through their fiscal and monetary policy. Fiscal policy is their budget. So every year the government sets a budget and they set how much money they're going to be spending on certain areas of government. Now this influences businesses because it determines, what taxes they're going to collect, what items and surpluses they're going to be charging, those kind of things. They also do something called monetary policy. That's where the Reserve Bank of Australia charge an interest rate. Now, what happens is the 4 big banks, or any bank in Australia, buys and sells money from the Reserve Bank of Australia. So pretty much the government sets a level of interest rates for businesses and consumers through the Reserve Bank of Australia. Once that's done, then so if the government increases monetary policy, which means they increase the interest rate, it means that to go and get a loan, it's now more expensive, which means the cost of getting that same car, that same factory upgrade, that same machine now costs you more because you're paying more in interest. So government can really control spending and consumption using fiscal and monetary policy. They also have government departments like ASIC, Australian Securities Investment Commission, to really control what's going on there. They also have company tax. That is, they charge 30% of your net profit goes to company tax. Global marketplace. Now, we've already spoken about this a million times. You've got exchange rates, interest rates. These things influence our financial strategies. The biggest two things that you need to remember is the 1980s deregulation. That is that the government deregulated a lot of financial investments so that businesses can now seek and get funding from businesses all over the world. So there's a lot of deregulation that happened both within Australia and for funding coming from overseas investors. The other really amazing thing is the GFC. My biggest recommendation to you is if you can integrate the GFC as like a case or a little quick example, do it. It is the best example that we have lived through. As much as it did cause a lot of drama and a lot of stress, a lot of financial loss, it is a great example for business studies because it proves to you how the government can influence our strategies for finances, how businesses are affected by other businesses, and how for the first time globalization proved that if a financial downfall happens in America, it can totally affect Australia almost instantly, and it has lasting effects that last years. So 2008 GFC, go and Google a couple of videos about it, go on YouTube it, get a bit of a brief understanding of what happened there. Really, really good idea. Next, planning and implementing your processes. Now, first things first, you need to determine what are your financial needs. Then you need to create budgets to determine forecasts and figures, setting budgets and limits to know what are your maxes and minimums of how much you can spend here. It then enables you to later on compare your actual and planned results later on. You also need to set up record systems like computer programs that record money coming in, money coming out. A good example is MYOB. That's a computer program that a lot of businesses use to manage their businesses, taxes, finances, employees, everything. You then need to assess the financial risk. And you need to make sure that the investment strategy or the financial strategy that you're employing matches your goals, matches your capacities. Otherwise, you're going to be, in a lot of trouble. Next is financial controls. That is, financial controls are ensuring your objectives are achieved by setting certain limits and restrictions on what you can and cannot do. So, for example, let's say we have in our company, we have a company and we have a staff member, that's paying out wages from our company's business account. A good financial control is setting up maybe like text notifications or setting up financial daily spend limits so that companies don't overspend too much, so that administration error doesn't happen, and so that the employee doesn't go rogue and start transferring millions of dollars into their own account. These are financial controls that are really, really important for us. Next is financial processes in debt and equity. Now, the important part here is we use a matching principle. Whether or not we use debt or whether or not we use equity financing depends on these strategies here. But the most important is we use the matching principle. That is that you need to give businesses advice to give and take the right credit option for the right amount. So for example, if I needed a quick short-term loan, there's no point in going and getting a 30-year mortgage. Why? You need to match the right type of debt to the right type of investment that you need with the right term of loan as well. So this might determine, are you better off going and buying it on an overdraft, or are you better off getting a long-term loan? That kind of thing. All right, now in monitoring and controlling, we've got 3 different statements. Let's run through them. So here you can see a cash flow statement. Now, in terms of calculation, it's quite simple. It's opening balance plus cash in minus cash out equals closing balance. Now, the closing balance in January will technically go up into February, and vice versa. The closing value of $5,000 in February goes up to March's opening balance of $5,000 as well. So let's go through and do a bit of maths. So we're starting in with $6,000. We're cash out of $3,000. That is, we're left with $3,000 at the end of January. Now, if we're moving over to February, we finish off with $5,000. So that March then starts with $5,000. And if we put another $3,000 in, but we've got minus X out, we're left with $1,000. Now, how do you find out how much the cash out value was in March? All you need to do is go 5,000 plus 3,000 minus X equals $1,000. And all you do is you move those numbers around to solve for X, and you'll be able to do it. Again, same deal. Once you do it once, you kind of get a bit of practice on it and you're able to do it. So, don't stress too much. Very, very simple stuff. Very, very easy. The reason we use cash flow statements is because it shows us where it's how we can understand and see how money is going in and out of the business. So for example, let's do April now. We're left with an opening balance of 1,000. Only 1,000 comes in, but 3,000 goes out, which means we have a negative 1,000 balance. This should be ringing alarm bells for you. This is a massive, massive problem. The company has not got enough money to pay for its financial stability here. This means we are not liquid. We cannot pay our debts in the short run. Why? We'll find out why later on. Let's continue on. Income statements. Income statements go through this same strategy, just following the same steps and procedures every single time. That is revenue minus cost of goods sold equals gross profit. And then gross profit minus expenses equals net profit. That's all it is. Very, very, very simple. So once you've got that set up strategy, memorize it, write it down 1,000,000 times. Revenue minus cost of goods sold equals gross profit. Gross profit minus less expenses equals net profit. Very, very simple. Every income revenue statement follows the exact same steps and procedures. The other good important thing is, remember how I was telling you how gross profit isn't as good an indicator as net profit? Net profit is better. Have a look. Whilst the company may look profitable because it's making $115,000 gross profit, it's only making $8,000 in net profit, which is not much at all. So by the time you pay off all your expenses, the company is only left with $8,000, even though it made $229,000. Where did that other $221,000 go? It went to expenses and cost of goods sold. Crazy, crazy, crazy amounts. So always look at that net profit. That's your biggest scale there. All right, next statement is the balance sheet. And as it suggests, current assets, non-current assets is equal to current liabilities, non-current liabilities, and owner's equity. You must remember that. Very, very important. In order to do it, again, use almost like algebra to put X's where you need to find out how much a value is worth. Remember, the left side must equal to the right side exactly. All right, now let's get into the dreaded formulas. Now, formulas are given to you in the exam, so don't stress too much, but the major thing is you need to know how to interpret it. It's also not that hard to remember the formulas. I would suggest it because it just really helps you really understand what's going on. All right, in order to measure liquidity, remember, liquidity is how able you are in the short run. You need to look at your current ratio. Your current ratio is your current assets divided by your current liabilities. Now, where do we get this information from? The balance sheet. What it shows us is how much financial stability we have in the short run. Can we pay our bills on time? Now, if we've got 1-to-1 ratio, that's too risky. It means for every dollar in an asset, we have $1 in liabilities. What happens if an unexpected bill comes in? We can't pay for it. 1-to-1 is too risky. 4-to-1 is inefficient. What's the point of having millions and millions and millions of dollars sitting in the cash bank, whatever, ready to go, if we're not investing that money in more profitable experiences? So 4-to-1 is too efficient. 1-to-1 is too risky. What's a good balance? Most textbooks, most industries say 2-to-1 is the best. That way, if you have any unexpected bills, you're not financially up shit creek without a paddle, but you can financially afford it. All right. Next is solvency. That is your ability to meet short and long-term debts. We use the debt to equity ratio, which is shown here on the screen. Why? It shows a risk to investors. So if we're relying heavily on loans, debt loans, other people financing the company, it shows that there's a higher risk that the company can go bankrupt. So the higher means the more unstable financially the business is. We need to make sure that we are financially secure by making sure we're balancing up that debt to equity ratio. Next, profitability. Profitability is measured by gross, net, and return on owner's equity. Now, they're pretty much all there, and what they show is for every $1 of sale, how much gross profit do you make? How much net profit do you make? Return on owner's equity shows you how much money is getting returned on the owner's contribution. This kind of shows you whether or not it's worthwhile for you to stay in business. So for example, if you measure your value of money and your profits and all that coming in, what's the point of stressing and running a business if you're not earning a return on owner's equity more than what you could have if you put it in the bank on an interest loan, or more than if you put it in property? You've really got to make sure your return on owner's equity is enough to not only sustain yourself, but to make sense to continue to run the business. Now, in terms of efficiency, we look at two different scales of efficiency. We look at expenses and accounts receivable. Expenses is for every revenue of dollar we make, how much does it cost in expenses? So the higher the expense, the more inefficient you are. You need to really reduce those expenses as much as possible. Next is accounts receivable. That is how effective and efficient you are in collecting that accounts receivable. So for example, if you say to customers, look, you have 30 days to pay your bill, and they don't pay it until the 37th day, that's not efficient at all. It means your collection is not doing really good. So you really need to improve that. Alrighty, now some financial processes here. Now, in terms of the normalized earnings, these are some limitations in financial reporting, by the way. Normalized earnings is when financial reports sneakily try and make adjustments for ups and downs in the economy to make the company seem more profitable than what it actually is. So you need to be careful about that. The way I remember it is, imagine you've got, economy going up and down, up and down. A normalized earning is when they take an average or a normal standard and they apply that, which kind of downplays the negatives that the company might go through. Not very ethical, and it is a limitation in reporting. Next is capitalizing expenses. That is, let's say I go and buy a property tomorrow and it costs me $1,000 to also hire a lawyer to transact the property. Just because the property is $1 million and I paid $1,000 doesn't mean the property is now worth $1,001,001. It's not worth that at all. You're still only worth $1 million. So what a lot of people do is they add the cost of those legal fees, taxes into the value of the asset, making it seem more valuable than what it actually is. You can't do that. Very, very bad. Again, valuing assets depends on, how and when you value your assets. Is different between every single company. So, you've got to be careful when comparing assets over time. What are the companies doing to depreciate and calculate depreciation? What's the company valuing their tangibles and intangibles, their patents, their trademarks, their copyright? Do they value, a copyright $1 million when it's really not worth anything at all anymore? Do you know what I mean? You've got to be careful about how companies value their assets. They'll obviously overstate it to try and make the company seem more profitable than what it is. Next is timing issues. That's when financial accountants try and move expenses into the next financial year so that you seem more profitable this financial year. We need to use the matching principle here as well. That is, record the transaction at exactly the right time. That is, the time it actually did occur. So make sure you do it the right way. Next is debt repayments. That is there, when we're looking at a financial statement, it doesn't necessarily show us, are employees about to go on leave? Are we covering vacationing stuff? Are we paying too much on our loyalty programs? That kind of thing. Last but not least is notes to financial statements. This is the most important thing. Have a look. Notes to financial statements, whilst yes, they can be a little bit biased, they help you give more details of what's going on, where, why, and it's actually helpful to realize and see how the company calculates its assets, what plans the company has, what debts the company has, how much the interest rates are, that kind of thing. All right, next is ethical issues. So again, we just need to be careful that ethically we're doing the right thing for financial statements. So when making financial reports, we need to follow certain standards. Now, these are made in chartered accountants. So a chartered accountant is an international standard for all accountants to follow. And when someone is a chartered accountant, it means that they've gone and undertaken training and extra understanding so that whenever they do financial reporting, it is equal for all businesses worldwide. Really, really good standard. We need to make sure that accountants aren't being creative in their reporting. They're not trying to sneak extra funds in somewhere or something crazy like that. The Corporation Acts 2001 also now states that we must reveal our salary packages for staff and directors. We also have something called the triple bottom line. That is where we measure the financial, social, and environmental impacts. So not only are we looking at just finances anymore, but we're looking at the social and environmental impacts of the company as well. And lastly, we're also looking at the audit. That is independent checks done by the Australian Taxation Office. They can come in and check your financial statements, making sure they are accurate, you're paying the right amount of tax, and that you are authentic. Because if you're not, criminal charges may ensue, fees as well as fines may be charged as well. So you have to be really careful with it. All right, now in terms of strategies are quite simple. They're pretty much everything that we've already discussed. Strategies are broken up into different sections. Ones that follow cash flow, working capital, profitability, and global finances. All right, so let's go through cash flow. Cash flow management is when we use a budget, for example, to make sure that we have enough money throughout the year. Ways we can do this to make sure we have enough money throughout the year and avoid negative balances is to distribute our payments. That is, spread large predictable payments throughout the year. So for example, when you're buying a car, you might insure the car and then have rego paid at a different time, have your green slip paid at a different time. That way you're not paying everything all at once in 1 month and suffering a big financial bang like that. Next is maybe offering discounts for companies who pay you early on your accounts receivables, giving them a discount to kind of incentivize them to pay early. Or you can also use factoring, where you sell your accounts receivable for a little bit lower, but you get the money instantly. Next is working capital management. That is making sure your current assets is greater than your current liabilities. Having that good balance, that efficient balance we were talking about before. How we do it, we can either control our current assets or control our current liabilities. We do this through making sure we've got enough cash on hand, making sure we've got enough accounts receivables and not having too much inventory. We can also make sure that we're paying our accounts on time and making sure we're paying them maybe on the last day possible so that we're maximizing that effectiveness of efficiency there. And we're also looking at, making sure we're getting the right loan with the right terms. We're looking at overdrafts, making sure we're not, spending too much on overdrafts. And we might even do something like a sale and lease back where, let's say you own the car, you can't afford to pay the car off anymore. So what you do is you sell the car to a leasing company and then you lease the car back off them in monthly installments. That might help some for working capital as well. Now, in terms of profitability, to maximize profit, you either have to reduce your costs or increase in your revenue. So to do that, you must do these strategies which run through here. That is running through things like setting up fixed and variable costs, making sure you're minimizing your fixed costs and your variable costs as much as possible. You can also use things like cost centers, which is where you use financial reporting to see where your wastage is coming from, which departments are spending the most money, why, how can we reduce that. By setting up cost centers, we can find those details out. We also must use expense minimization, finding new, cheaper suppliers, seeing how you can get a discount from your current suppliers, things like that. Revenue-wise, we need to make sure we've got good marketing strategies so that we're increasing our revenue and sales. We can also adjust our pricing according to demand, stocking, quantity, in order to maximize revenue as much as possible. All right, last but not least is global financial management. So when a company interacts with finances overseas, they're obviously going to have to do encounter exchange rates, which is the value of purchasing one currency for another. So what a lot of companies do is they need to be careful and use some strategies, which we'll go through in a second, called hedging, in order to enter a contract with a business and supplier using one equal currency. So for example, we might, even though I'm in Australia and my supplier might be in China, we both might agree to do the transaction in US dollars. That way, any ups and downs are equally felt by both company and supplier. What you have to be careful of is that if you're not doing things like this, you know, a product that might be worth $1 today might have an exchange rate that goes up, meaning the same item might be worth $1.20, $1.30. That's why it's very, very scary. You've got to be very, very careful. Similarly, think about the new iPhone. The new iPhone in America sells for $999. In Australia, that's $1,589 or something like that, which, you know, when you take into the fact of exchange rates, that's how much the item is worth. So you've got to be careful about that. Very, very important. All right, next is interest rates. Interest rates is the cost of borrowing money, and now with global finances, a lot of people go and seek money from overseas because it's cheaper, it's less interest rate, that kind of thing. What you do have to be careful of is there are different laws, different risks associated as well. So you can't, you know, just go and invest $1 million in Zimbabwe because you might not ever get your money back, if you know what I mean. Next is some strategies. To do this, we look at the method of international payment. So, for example, some companies use payment in advance, letter of credit, bills of exchange, those kind of things, which reduce and get rid of the risk. So to quickly go through these, a payment in advance is when you pay for the item before it is sent. It's the most riskiest for the person who is buying the item because they're paying for it in full before they've even gotten anything. Whereas a clean payment, on the other end, is when you don't have to pay for the item at all until it arrives on your doorstep. But again, very risky for the supplier. What we do is we use letter of credit and bills of exchange in order to move that risk from one or the other into a third party, usually a bank. So the bank can either issue a letter of credit or a bill of exchange requesting certain amounts under certain conditions, so that money is held on trust with the bank and isn't released to the other party until all the terms of the contract are fulfilled. Good way of doing business, especially to reduce risk. So we've already gone through hedging, but we can also use something called derivatives. Now, derivatives is where you buy and sell certain currencies using swap contracts, currency options, or forward exchanges in order to get that financial strategy underway for exchange rates. That's it, guys. Finance is done. The whole finance topic covered in 37 minutes. Not bad, I say. Alrighty, let's get on to human resources in the next video. My biggest recommendation for finances is practice, practice, practice. For me, finance was the hardest, as it probably is for you. Go into those exam papers, find those questions, and do as many practice questions as you can. It's the easiest way to get that content down and dusted. Alrighty, have a good day. We'll see you in the next video.